Chapter 7 deals with cash and receivables. Starting out with Part A, cash and cash equivalents. Cash includes currency and coins, and balances and checking accounts. Now, for financial reporting, specifically on our balance sheet or statement of financial position, we make no distinction between cash in the form of currency or bank account balances and the amounts held in cash equivalent investments. Cash equivalents would include money market funds, treasury bills, and commercial paper. Commercial paper is a form of borrowing from other corporations that have a very high level of assets. So it's basically Corporation A borrowing from Corporation B. These cash equivalents must have a maturity date no longer than 3 months from the date of purchase. Companies have some flexibility in designating cash equivalents and can establish those in their individual policies regarding investments classified as cash equivalents. And the policy for cash equivalents should be disclosed in the notes to the financial statements. We see an example for Walgreens in illustration 7.1 that indicates their notes footnote describing cash and cash equivalents. Now, if you have credit card and debit card receivables from banks, those will typically settle within 5 business days, and these credit and debit card receivables are often included in your cash equivalents. Cash equivalents are often combined with the cash and reported as a single amount in the balance sheet or statement of financial position. Cash that is not available for use in current operations, current being a year or less, because it is restricted for a special purpose, usually is classified in one of the non-current asset categories. Since cash is the most liquid of assets and the most easily expropriated or misused, we should have a sound system of internal control of cash. That is a key accounting issue for all corporations. Doesn't matter what size you are. Now, internal control refers to a company's plan to adhere to its own policies and procedures, to promote operational efficiency, minimize errors and theft, and enhance the reliability of the accuracy of accounting data. Now, from the Sarbanes-Oxley Act of 2002, that act requires companies to document their internal controls. And the Public Company Accounting Oversight Board's auditing standard number 5 further requires auditors to express an opinion on whether a company has maintained effective internal controls over their financial reporting. At KCCDD, we just have concluded our fiscal year 2015 audit, independent audit, and part of that audit will require the auditors to issue an opinion letter to the board of directors describing the effectiveness of KCCDD's internal controls. So it doesn't matter what size your company is, you have to have that done as part of your independent audit. Now, you also get some help in designing an internal control system by COSO, C-O-S-O, which stands for the Committee of Sponsoring Organizations of the Treadway Commission. And COSO defines internal control as a process that companies will try to achieve objectives in the following categories indicated by the 3 bullets here on page 363. Those 3 categories are effectiveness and efficiency of operations, reliability of financial reporting, and compliance with applicable laws and regulations. Now we're going to have internal control procedures both for cash receipts and cash disbursements. First section here, cash receipts, separation of duties is critical in the internal control procedures for cash receipts. And what you have with separation of duties is that no two individuals will have physical responsibility for the assets, and that's where you're going to be handling the cash or the checks, for example, taking them to the bank. That person should not have access to the accounting records. So you're going to want to separate all employee aspects that deal with cash receipts so that one person is not performing more than one task related to your internal control process. We have an example here with employee A, employee B, and employee C that kind of gives you an idea of how you might go about separating the duties for cash receipts. Employee A here is opening the mail each day and preparing a multi-copy listing of all checks, including the amount and payer's name. At KCCDD, we actually have two people that open the mail, and those two people sign off on that listing of the payers and the amounts of the checks. And that original is kept in that area. Photocopies are made and distributed to the accounting personnel, as we'll go through here in the next couple of steps. Employee B will take the checks and a photocopy of that original listing to the person responsible for depositing the checks in the company's bank account. At KCCDD, that person happens to be our accounts payable person. And that staff person does not have any function in the accounts receivable module, and we can specifically exclude that person from the accounts receivable module in the system setup on our Sage 100 accounting software. The third step here mentions that a second copy of the check listing is sent to the accounting department, where employee C will enter the receipts in the accounting records. And we have a person who is in charge of accounts receivable at KCCDD, and that staff person will enter in that the cash receipts information, will not have any physical handling of the cash or checks at all. Specifically, this person, in this case employee C, will only be entering in that information into the accounts receivable module of the accounting software. After the employee has taken the cash receipts and checks to the bank for deposit, the bank is going to record that deposit slip in their system, and it will have some printed information once they run it through their machines. That check deposit slip can then be verified with the information that was recorded back at the accounting office of the business. Now, on the opposite side of the cash receipts, we have the cash disbursements. And we have some internal control procedures in order to safeguard the assets here as well. The important elements of a cash disbursement control system would include that all disbursements should be made by check. Now, you will have some small disbursements that will be made out of petty cash. So generally, you'll have a policy and procedure for establishing a petty cash fund to pay for items that are generally less than $5 or $10, somewhere in that neighborhood. But anything over that petty cash limit will run through the accounts payable system as a general disbursement made by check. All the expenditures that are authorized before a check is actually prepared will go through a process. For example, you'll have a vendor invoice that documents the purchase. In this example here, in step number 2, it's a purchase of inventory. Well, that invoice should be compared with the purchase order that was internally generated at the company and the receiving report to verify that the assets received, in this case inventory, are in good order, and the quantity cross-references to the invoice so that what we received in quantity is what we're actually paying for. And additionally, we want to verify that the proper ledger accounts are being debited in relationship to that invoice, so that when we actually go out and do our physical count of inventory, that what we have already entered into the general ledger is recorded properly, so that we have a good match when we do our physical inventory. And the last thing, number 3 there, is the check should be signed only by authorized individuals. Now, in a lot of companies these days, including KCCD, we pay a lot of our cash disbursements by ACH or automated clearinghouse, and that's an electronic form of payment. We still have to go through these same procedures, but the electronic payment of invoices is a much safer way than actually mailing paper checks. So you would still have your internal control procedures even though you're paying invoices electronically. The responsibilities for check signing, check writing, check mailing, cash disbursement documentation, and record keeping should all be separated whenever possible. That's good characteristics of a good internal control procedure. And also, part of any internal control of cash involves the bank reconciliations that must be done that reconciles the balances that you have in your general ledger accounts that deal with cash and reconciles those amounts to the amounts listed on the periodic bank statements. The next section we deal with is restricted cash and compensated balances. With cash, if you have cash available for current operations, that cash will then satisfy current liabilities and will be appropriately classified as a current asset. Cash that is restricted in some way and not available for current use should be reported as a non-current asset. Now, restrictions on cash can be either informal or formal. If they're informal, they generally arise from management and their intent to restrict cash for a specific purpose. For example, if they want to add on a physical area to their existing plant. So they want to expand the plant so that they have more operating capacity. That would be something that's informal in nature. Sometimes restrictions will be formal and are contractually imposed. For example, if you have a debt instrument where you're borrowing money, you may have a covenant within that debt instrument that says that you have to set aside some money periodically to allow for the future payment of that debt. That setting aside money, the type of account is called a sinking fund. Now, you should have some disclosure notes that describe any material restrictions of cash. So you should be writing footnotes in addition to the financial statements that you are preparing. Some banks frequently require cash restrictions in connection with loans or loan commitments, i.e. line of credit. Now, sometimes the required balance could be in a percentage amount, for example, say 2 to 5%, as we're shown here. That percentage that is set aside and maintained on deposit with the bank is known as a compensating balance, because we are compensating the bank for granting the loan or extending the line of credit to us in the first place. Now, a compensating balance results in the borrower paying an effective interest rate that is actually higher than the stated rate on the debt. In our example here, we've got a company borrowing $10 million from a bank at an interest rate of 12%. Now, the bank requires a compensating balance of $2 million. So we're actually getting to use $8 million. Now, the loan at $10 million, the interest rate is 12%. $10 million times 12% is $1,200,000 in interest. However, we're paying $1,200,000 in interest on $8 million that is available for our use. And when you do that division, the effective interest rate is 15%, as opposed to the stated rate of 12%. So what happens here is when you have a compensating balance, you effectively have a higher interest rate than the stated rate on the debt. Now, when you classify and disclose a compensating balance, you need, if this restriction is legally binding, which is generally going to be the case when you have a compensating balance as part of a borrowing of some sort, a line of credit or a note, the cash is classified as either current or non-current, and it is depending upon the classification of the related debt. You will write a footnote about that as is indicated here. Now, if the compensating balance arrangement is informal, if there's no contractual agreement, it should be reported as cash and cash equivalents and a note disclosure of that arrangement as well. A couple of final points in this part A is that cash is vitally crucial to the ongoing operations of a business. And because cash inflows and outflows can vary from our planned or budgeted amounts, we need to make sure that we have some cushion as a precaution against any type of surprises. Now, we have a couple of ratios that will help us measure what our cushion is. That would be the current ratio, which is simply dividing the current assets by the current liabilities. That is one measure of liquidity. And the other one is the acid test or quick ratio. And here our numerator consists of quick assets, which consist only of cash and cash equivalents, short-term investments, and accounts receivable. The other two types of assets that would normally be in the current ratio but are not in the quick or acid test ratio as the inventories and prepaid expenses. So by eliminating those two, the inventories and prepaid expenses in our acid test or quick ratio, we get a more precise indication of the short-term liquidity than we would with the current ratio. Now, one final point in this part A is that you can never run out of cash, because even if you're profitable as a business, if you run out of cash, it can force you to discontinue your operations. So, as it mentions here in this last paragraph, you want to make sure that you manage your cash so that your company will never run out of cash. So cash management is vitally important to the ongoing operations of your business. That will conclude lecture for part A of chapter 7.